Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. It's Wednesday. It's June 29th. June is almost behind us, and 4th of July holidays are right around the corner. Now, the markets are opening up slightly soft today, nothing major. We had a little rundown yesterday, but we're looking to see what's going to happen ahead. We have a big day today. We have the GDP report. And if I could find it right here, here's the GDP. Expectations is negative 1.4%. If we can go a little bit above that, that would be really great. If we can get to 1.2, 1.1, then the Fed could say things are not as bad as we thought they were. Maybe we don't have to be as aggressive. If the numbers are 1.5 or 1.6, they may have to get a little more aggressive the next time, and you may see some more downside in the bond market. If the number's better than expected, then we can expect the bond market to potentially rally. That's the first thing we take away from this. Now, let's talk a little bit about global economy. But first of all, we had the consumer confidence report, and I'll be going back and forth. The number, this was yesterday's data. It was a little bit below expectation, which confirms what we saw the week before, that consumer sentiment is declining, but it wasn't as bad as it could have been. The other report we had was international trades and services. The consensus was 102 billion. We were at 104 billion, but again, not as bad as we could have been. And again, the numbers for the imports and exports were not that great. Number for imports was slightly revised to the upside, which was better. Again, everybody's focused on the GDP, and this is what the consensus is right now. I'm really looking at personal consumption, because even if this number is at 105, but personal consumption can increase, it would be very beneficial. It would be very beneficial. So it's a combination. It's not just one thing. So if personal consumption says goes up to 3.3 and GDP stays at 1.4, it's telling us things the consumers are starting to spend, or spending a little more, even in light of what's happening right now. Or the number could be a little higher and personal consumption can be a little weaker. It can go either way. But most importantly, is what I'm going to predict the future, Jerome Powell is going to say after the report, and that happens before the market opens. So before the market opens, we should have a good idea of where we stand right now, at least in terms of the GDP. Commerce Department was due to report first quarter GDP report. That's what I was just talking about. That's happening in about 39 minutes. Investors are worried about uncertainty over inflation, rising rates, and potential for a recession. I would say right now we're at a 50-50 level right now. Weaker than expected consumer confidence reading, that's what I was just alluding to, highlighted worsened consumer expectation due to obviously persistently high inflation. The Conference Board reported Tuesday that its consumer confidence fell in June to its lowest level in more than a year. Results that were weaker than economists were expecting. Again, it's just one of those situations right now. Central banks are raising rates to try and tamper inflation after years of holding rates down, which was not very beneficial. But I remember somebody by the name of Donald Trump pressuring the Fed to keep rates lower. Do you guys remember that? Here we are. That's one of the factors. Investors fear they could go down further and push economies into a recession. Wall Street is bracing for the next round of corporate earnings in the next few weeks. That's going to be very telling. They will paint a much clearer picture of how the companies are doing with the current supply chain issues, with the rising costs, consumers curtailing some spending. So there's a lot of factors to pay attention to. But again, that report is going to be coming out in about 37 minutes, the GDP report. Pay attention to the negative 1.4 and the 3.1 positive for the consumers. So again, let's look at what may be impacted, the bond market. If you guys start seeing the bond market, notice down, stocks go down, sideways, stocks starting to move sideways. And healthcare is now starting to lead instead of energy, at least on a monthly basis. The bottom line is, the more the bond market can continue moving sideways, the better it is, and the lower the risk that the Fed is going to raise long-term rates, or the long bond is pricing in no more rate hikes or no significant rate hikes for the foreseeable future because it's moving sideways. Now, if the bond market starts going down again, and it will, it's just a matter of time, it's going to put more pressure on stocks. But till we're here on the sideways channel, That's more of a wait and see approach. Also, volatility, as you could see here, came off of the 34 level. Now it looks like it's near the upper end of the lower range. I'm hoping that volatility will go down. The ideal scenario would be for the GDP to be very positive and for the market to bounce back today, but I don't know that'll happen before a nice bounce. On a 5-day cumulative, you still have defensive sectors leading: utilities, real estate, healthcare. On a 30-day basis, you've got some communication services, consumer discretionary starting to come up. So we're kind of mixed right now. The market is trying to find its direction or its footing between the strongest sectors and the weakest sectors, and seeing if it needs to readjust itself. Because between January and now, just to show you, energy was leading on a cumulative basis, and it's still leading on a cumulative basis, and consumer staples is number 2, and utilities is number 3, and healthcare is number 4. This looks about right. But look on a monthly basis. You've got energy all the way down here. You've got consumer staples all the way up here. Then you've got consumer discretionary making more upside in the last 30 days. And then you've got technology in the third spots. We're all over the place. So that's one of the reasons we've been seeing an imbalance. So it'll be very interesting to see if, one, this imbalance continues to grow, which means consumer discretionary, technology, and financial will start moving higher, or we go back to energy, consumer staples, utilities. So it's a really interesting time right now. And for the first time, you're starting to see non-energy stocks dominate here. You're starting to see some consumer staples and healthcare along with energy like Valerio and Occidental. So today is Wednesday, and I always give you my top stock and my bottom stock. Top stock, I still like Oxy. I think energies still have more upside to go. I'm pretty bullish in the energy sector overall. I like Oxy, and it's the number 1 stock Warren Buffett is buying, and it happens to be my number 1 stock in my S&P 500 scan. To the downside, Kimco Realty. I mean, this thing made an all-time high all the way in March. It's been coming down. It just came back up to the 20-day moving average. The RSI is almost overdone. I think this thing is going to go for another down ride, especially if it didn't peak out all the way till March of this year. So I think more downside for Kimco Realty Group. If you look at the profile of this company, they do investment trust, largest publicly one of the open air shopping centers. Yeah, I don't know if people are ready to go shopping centers with the economy being where it is right now. I think that's one of the things that may be going to the sidelines, and their dividend is declining. Yeah, so again, I don't know if shopping centers are the best thing with a potential recession looming right now. Investors may want to think twice. So on the upside, we've got Oxy. On the downside, we've got Kim. Before I let you go, and folks, let's see how the market shakes out after the GDP, and let's see what Powell says. Let's not make any big decisions, okay? Summer's here, and that means most of us want to travel, enjoy time with our family, or hit the pool. Heck, all of the above. But you're probably spending more time worrying about what the Federal Reserve or the S&P will do next, right? So it's time to cut it out. Worrying isn't going to get you anywhere, especially when there's a better approach. Trading legend T-Buzz just shared the details of a single stock game plan with me. It's very, very cool. And I was blown away by this hyper-focused trading method. It's simple, easy, effective, and perfect for the summer. Tom has slashed the worry and stress from his life, all by focusing on one stock, one trade, one opportunity to profit at a time. Now, he's spending his free time doing what he wants, like playing golf, hanging out with me sometimes. We have a good time. We went to see Top Gun this weekend. Oh yeah, it's like that. Click here to learn how to gain access to Tom's single stock game plan. Tomorrow, top ETF, top option pick. Follow the link below. You got to check out T-Buzz's single stock game plan. It's very, very cool. And I'll talk to you guys later. Have a great day. Comments, feedback, emails. I want to hear from you guys. Bye. Have a great day. Let me know what you're doing this summer. If you're having a little fun in the sun. Bye.